Shruti, we can put the main screen slide.
So Reid, on the first two, I will slides, I'll give my little spiel as, you know, sort of outlined in the notes, and then I'll hand it off to you. And then when you're done, just ask for the next slide.
Great.
Okay. And then similarly on the ones that you're leading, just I'll let you finish before I talk over you.
Welcome everyone to the Marsh webinar, Resilience and Emerging Risks. We'll be starting shortly in a minute. We have a number of participants already joined in and many more are joining in. Once again, a very warm welcome to all the participants who have joined in the Marsh webinar today, Resilience and Emerging Risks. I'm aware that many more people are joining in as I start the webinar, but in the interest of time, I will kickstart the webinar. I introduce myself, Sanjay Kedia, Country Head and CEO for Marsh. Next slide. May I request everyone who have already joined in that you have an opportunity to raise a question anytime during the webinar. You can place your question by pressing the Q&A tab on the bottom of your screen. And we will be running a number of polls where we encourage you to please participate and share your thoughts. Next. I have the pleasure of introducing our expert panel for today. We have Mike Poulos, President, Marsh Advisory, based out of New York. He is responsible for our businesses, whether it's risk consulting, captives, claims, analytics, and more. So thank you, Mike, for making it from New York in your early morning to be with us with clients and colleagues at India. We have Reid Sawyer, Managing Director, Head, Emerging Risk Group. He also leads the US Cyber Consulting practice. So thank you, Reid. And all of you know Paul Wilkins, based in Hong Kong, leader of Marsh Asia Risk Management Practice and also the Chief Client Officer for Marsh Asia. So we have an amazing panel from New York and from Hong Kong to talk on the subject for today. We have over 150 participants already logged in, and I can see many more joining in, but we will kickstart our program for today. Yes, next. Let's start our first poll question. Which is the most critical risk for your organization? Yep, it's very interesting. We have cyber topping the chart with climate perils and operational perils on-site incidents closely following. Thank you. Next. This is the Global Risk Report 2020 released by Marsh & McLennan in part for World Economic Forum, which shows the impact and likelihood scale. And it's very interesting to see, this is prior to pandemic. This release was done in the month of January of this year. And you see infectious disease, that is the pandemic, very much on the table, very much at par with cyber attacks in terms of the impact, very much on the table. Mike, any comments on this slide? You've been very much involved with this project with World Economic Forum, creating those reports, Global Risk 2020.
Sure. Thank you, Sanjay, and thank you for having me today on the program. Yeah, I mean, so it's really important to keep in mind we've been working with the World Economic Forum for the past, it must be close to 20 years on the Global Risk Report. And every year, what we do is we survey a number of members of the forum. Those are largely the sort of corporate executives from participating institutions, but also other experts in the insurance and financial services group to help them think, or to help to find out what they're thinking about in terms of what their what the large risks are. And we always ask them to sort of think about two different dimensions: the likelihood that something's going to happen and impact. And those move around. I mean, one of the striking things about this year's responses were that the heavy weighting towards climate-oriented risks, which is perhaps not surprising given recent events, and given the amount of media coverage that that climate events and climate risks receive. Pandemic is always in the mix. Infectious disease is always in the mix of these risks. But I think that with respect to this year, obviously, for one thing, the group underestimated the likelihood of the pandemic risk. I think also, if we're fair, they underestimated the severity. So infectious disease was high in severity, but not as high as some of these other risks. And I think in particular, we'll talk a little bit about this as the presentation goes on. The velocity with which the pandemic swept through the global economy was really quite extraordinary. So, if I contrast that with climate risks, however serious one believes climate risks to be, there's, I think, no one who thinks that they are going to develop on a timeline that's other than decades. So we have an opportunity to react and to course correct over time in terms of our responses to climate. With the pandemic, it went from being sort of almost completely off the radar to the global economy being significantly shut down in something like 8 to 10 weeks, and that, I think, is really a metaphor, if you will, for globalization and the speed with which risks can manifest themselves, and the velocity with which risks can manifest themselves this year. And then I believe you also have another picture
Yes.
that gets to the question of interconnectivity. But
yes.
clearly that's a huge dimension as well.
Thanks, Mike. I'll just take to the same question. Next slide. This is on the interconnectedness of risk. We see different risks are interconnected with each other, and infectious disease has amplified during this pandemic all the red circles which you see, from unemployment, fiscal instability, financial crisis, cyber attacks, involuntary migration. They've all have been severely activated or amplified. So Mike, any comments on these?
I mean, only to say that it's a complicated world. It's an increasingly connected world, and the policy response to the pandemic was a major contributor, obviously, to many of these other risks being, if you will, kind of activated. So we in a way, we made a conscious decision to trade off a greater economic crisis in order to try to control the epidemiological crisis, and that's not without very significant both near term in terms of the real economy essentially shutting down in the first and second quarter of this year, but also longer term in terms of exacerbating long-term fiscal imbalances and deficits and debt loads, as well as affecting essentially long-term kind of monetary policy for many of the major global currencies.
Thanks, Mike. Next. A quick poll question from everyone. Looking at the near future, 12 to 18 months, what in your opinion will be India's biggest areas of concern? Prolonged recession, weakening of fiscal position, surge in bankruptcy, surge in unemployment and inequality, cyber attacks, health systems overstretch. It's interesting. It's difficult to pinpoint. There's so many things which gets activated, and that's what happens. Next. The fiscal position remains the biggest concern in the recession. Yeah. Now, Mike, before I hand over to you and Reid, just want to share with all the participants that MMC released another report, a special report of COVID-19 implications for World Economic Forum recently, and it had also mentioned the long-term fallouts, and that's what most people are concerned as risk managers, as leaders. The surge in inequality on the societal side, anger with the government, electoral surprises. These are some of the long-term impact on the societal side. Political side, the increased government surveillance, be it Arogya Setu or very different forms of interventions, you will see, and they will here to stay. Weakened fiscal positions, which all of you pointed out in your survey just now. Developing economic collapse, the concern around that, not necessarily a collapse. The resurgence of US-China conflict. We are seeing a lot of India-China conflict over here. The deglobalization pressures will continue to be and stay with us for a long time. The consolidation, the supply chain retrenchment. So these are all something which will continue with us for even if the pandemic is out and we have a vaccine, but these are likely to stay with us. So that's a long-term implication. So with this, Mike, I hand over to you and Reid to touch upon not only on pandemic, but basically shock events, the risk events, which could potentially shake organizations, shake the economy, and shake the globe. How do we measure them? How do we deal with them? How do we prioritize them? And more importantly, what is the resilience and framework which organizations can do and deal with? So with this, I hand over to Mike and Reid. And before that, Mike, you want to run this poll question? Yes.
Okay. So sure. So the question is your organization actively involved in mapping and preparing for key emerging risks?
Yep.
Okay. So obviously, we've got a very engaged group on this topic, so hopefully we'll be able to add a little bit to your thinking and preparation. Can we maybe move into the next slide?
Yep.
And okay, there we go. Perfect. So as Sanjay has sort of indicated, we've been thinking quite a lot about resilience and emerging risks over the course of the pandemic. It's really highlighted the importance of preparation for the kinds of risks that may or may not, and this is sort of our working definition of emerging risks, are risks that may or may not be amenable to insurance-oriented solutions. So that doesn't mean that there's no insurance solution at all, but it tends to be less developed than it's like property cat or typical casualty lines. So in the broad bucket of emerging risks, we would put things like cyber and technology, we would put pandemic, we would put climate-oriented risks, and geopolitical, just to sort of take some of the headline ones. And our thesis is that emerging risks are really posing new challenges to our clients who are looking to maximize their risk resilience and their ability to quickly recover from shock or risk events. And among the things that are on our mind, one is that we referred to earlier is velocity, the speed with which risks can manifest themselves is definitely increasing in a world of technology, high mobility, and globalization. The second is sort of the systemic nature of many of these emerging risks. So if you think about cyber risks, or certainly pandemic is perhaps the best example of this, is that they're not localized events. They lend themselves in many respects to being either market-wide or in some cases even globally systemic, which makes them that much more challenging to react to. And then the third issue that we've been thinking quite a bit about is sort of the possibility of contemporaneous occurrence of multiple perils. So we've been reading a lot about cyber risks being heightened during work from home as tactics that have been used and deployed to address the pandemic risks. So it's a very sort of meaty problem. It's one that requires quite a lot of effort, and we see there being at least four big sort of imperatives for today's risk managers and really all managers in terms of increasing their sophistication with respect to risk management frameworks. The first of these is to broaden the lens and the scope of what you're thinking about, to take into account a wider range of risks than those that are easily insurable. The second is to consider various vectors in which different risks can manifest themselves. So, by that I mean sort of first party sort of property is different from third party losses or supply chain. Or perhaps fines and civil liabilities. The third is to develop sort of quantitative metrics and to both estimate the potential impact of these risks and to sort of compare them to risks that are more on the sort of traditional list of insurable risks, and to put those forth into a framework that allows for this sort of quantitative comparison of risks, so that you can prioritize on your risk mitigation strategies, which might include laying off the risk, being some sort of hedge or insurance, but would also include other actions you can take to lower your total cost of risk or your exposure. We can go to the next slide. Reid, do you have anything you want to add before we go on to the next slide?
Mike, I think that the only thing to think about is that when you are articulating those four elements, those imperatives, as we think about the future of risk, especially as property markets remain challenging and liability markets are beginning to harden, and moving forward from that perspective is, ultimately then from a risk professional perspective and the transfer of that capital, can we view it through the lens of ROI? And I think that next slide, Mike, will tell us that, give us some real insights to that.
Great. So this page is pretty pretty busy, and I won't. The point isn't to sort of take you through every cell or row and column, but the point is to just illustrate what a framework might look like, where you start to lay out in the different rows different risks that an organization might face, and we've highlighted in red font in a few of the rows some of these select emerging risks, and then across the columns the different sort of vectors in terms of how those risks might manifest themselves. And then each one of the cells, what we've tried to do is give a sense for what is the degree to which insurance coverage is available, and some of the cells are are not applicable, but what you'll see, generally speaking, is that there's a wide range of insurance options, and some, so it's not a binary situation where either there is or there isn't insurance. Sometimes you have partial or sort of incomplete markets, or maybe markets where there's some coverage available, but it's either very expensive or limits are lower. Generally speaking, what you'll see is there's less green in the emerging risk rows, and more of the reds and oranges, and the general point is to say that the fact that we're, many of us here are very close to sort of the insurance buying decisions that are happening in our organizations, makes it very sort of comfortable for us to kind of live our lives in the green cells, if you will, on this page, and just concentrate on getting the best deal on your next renewal, or taking a look at what your sort of what your limits and retentions are. But we think that it really is important to kind of think more holistically and try to quantify, to the extent that you can, some of these risks that are more perhaps difficult to insure, but not necessarily less important to an organization. So we think that a more comprehensive view of risk would not include those risks or perils that would not be addressable via insurance, and a complete risk management strategy really does require that comprehensive approach. So Rita, you probably have some perspectives on this page as well.
You know, Mike, this is increasingly, this type of analysis is what our clients are asking us to contemplate, is to understand that space between the traditional risks, as you've put it, in the emerging risk classes. And indeed, it's I think critical as we go through the rest of this discussion. We're talking about issues like pandemic or cyber, these other classes or areas of emerging risks, that we also acknowledge that these are ultimately impact. And you know, as you see from the columns of this type of framework, but that these ultimately impact us back again on our traditional risk classes. And so, continuing to ground ourselves in those points, while understanding where we can and can't transfer, is becoming a critical question as companies and indeed their boards are paying more attention to this question.
So do you want to run with it?
Yeah, sure, Mike. Thanks, and good afternoon, good evening, everyone. And Sanjay, thank you from myself for inviting us to be part of this this event, as Mike had previously noted. You know, as we think about this idea of pandemic, Sanjay, that you were highlighting in the World Risk Report and that Mike was referring to earlier, you know, much as we think about this risk, and it's almost difficult to believe that depending geographically where we are, you know, where we're sitting in the world, right? This crisis either became apparent, you know, or started to impact us in a significant way, you know, between 7 and 9 months ago, and it's just hard to believe almost that we're closing pretty quickly on the year point of when experts started to pay attention to this crisis, even if it wasn't entirely understood, or as Mike talked about, right, the differing approaches and the policy solutions that were then applied to this. But what was clear in the very beginning, and as we take a look at this example, right, this very much of what we might think about as an acute crisis, but one of these elements that where we believe, and depending on what happens in the next several months and coming into next summer with COVID-19 and whether or not it remains a pandemic, or whether, as some are starting to suggest, where we need to start contemplating this as conditions of an endemic that we're going to be dealing with for some time. But really what we want to do from this example is think about the lessons that we might learn that we can incorporate into a forward-looking or longer-term risk management strategy. So this continuing challenge of COVID-19, and indeed in the U.S. Through the weekend, right, many states here in the United States are witnessing increasing numbers again as we're starting to deal with these types of issues. And so the question then becomes ultimately is, what are those net impacts? How do we understand those costs? And what does this continued fragility look like as we start to move forward? Very early on in this question, from a risk manager's perspective, we were asked, very early on in this crisis, from a risk manager's perspective, we were asked this central question, which was this drive for clarity. What is happening? How do we make sense of the data that's around us, and what is that data telling us in a way that we can make and lead to the decisions? And these were the types of questions that were being asked of us, of our clients, you know, sort of in the February, March, and April timeframe, as we were dealing with this uncertainty and this really the novelty. And again, back to Mike, to your point, right, the velocity of this crisis, about how quickly we shut down the real economy in response to the pathogen as it started to move forward. What we very quickly started to understand, though, is this need to be able to present to our clients, to you all, right, to clients like yourself, is this idea of bringing together forward-looking analytical models, not only to make sense of the data of what's happening today, right, with the actual experience of what's happening, and to bring those disparate data sources together, but also then to create projections of the future and forecasts, right, which alone are not sufficient to evaluate future business decisions or future risk decisions that we were making at that time. And so to do so, and how we have evolved, just much like all of us have evolved through this crisis, is really the incorporation of multiple data feeds and projections from multiple different platforms and modeling sources, and incorporating that data with our own sense of this to be able to provide clients information about the speed of that transmission, morbidity rates, mortality rates, but almost more importantly, right, to be thinking about how fast and what are those recovery rates from the disease, so that we can think about this at a localized level, even in the United States down to the county level, right, a very small segment of the population. What has become clear, though, from those very early days of this idea of providing this drive to provide sense making, if you will, over these disparate data sources I was alluding to a few moments ago, is now this need to then be able to tie this information into the risk decision frameworks. And Mike, I think it's instructive maybe to take this out of the abstract and perhaps for a moment, if we could talk just about a case from a recent client that we dealt with. And in that sense, it was really a global professional services firm, 500,000 people in size, with a very considerable presence in India. And the concern of that C-suite, as they retained Marsh to address this question, was not just about, build us a model that will tell us about the impact on our own population, but help us start to take that information and build risk decision support frameworks, right? This idea of how do we translate that data into knowledge so that we could assist the client in thinking through questions like load balancing, right? Do I, with my critical centers in Mumbai and 4 other cities in India, do I need to be thinking about transferring that knowledge and load balancing to other geographies? And am I at risk because of the potential? And at that time of the year, right, the unknown was how resilient or not any of us were going to be, let alone the operations side of India. And so what became very quickly, what started as an operational risk discussion, very quickly through our engagement with the C-suite of this global professional service firm, became a strategic risk, one where we are having to make decisions or guide the client through their decisions, more appropriately said, as to the type of risk that they were facing. Mike, any comments or thoughts about this? You've been intimately involved in these discussions.
Thanks, Reid. Yeah, I would say the main thing that I would just add is obviously what we've been talking about in this particular case study is crisis management, right? Like the event occurred, right, and then we had to react to it in real time based on sifting through a huge amount of information that was flowing and getting down to what deciding what's really important. And I think that in many respects, the experience of going through this pandemic will shape the way that any future pandemic is sort of planned for, and the preparations that are made for that contingency going forward. And what the analogy that I would draw is what happened during the global financial crisis, and the degree to which policymakers had to really sort of feel their way through over the course of months or even sort of almost 2 years in terms of policy responses allowed, there was quite a lot of learning that happened from that crisis management that allowed particularly sort of central bankers in the large Western economies to react with much greater alacrity in this crisis. And I think that will prepare us, our experience in this crisis will prepare us for future infectious disease events. And I think that we will be smarter about it, but it is very important that we consciously take those learnings on board and then reincorporate them in our risk preparation for the future.
Fantastic. Next slide. So if we could take another poll question, exploring this time around cyber risk and whether or not you agree that there's an increased cyber risk exposure for your organization. perhaps we can see the poll results as they come in. So not dissimilar to the first poll question, Sanjay, that you led off with, right? Asking the question on, what is the biggest risk? And in that case, the audience seemed to agree that it's cyber. And in here, as we look between agree and strongly agree, almost 95% of you that this is going to be a future increased exposure for your organization. So let's go to the next slide with that in mind. As a secondary aspect, or second element rather, of emerging risks, talking about technology and cyber risks, I'd like to direct your attention just to that upper left-hand corner of the blue box. Some prior work that we did in surveying clients like yourselves, right, that said very much similar to almost sort of polling response that we just saw a moment ago, was that almost 3/4 of the organizations we talked to at that time thought that cyber attacks were still a bit of a black box. And they put it this way, it's sort of the words of one of the respondents, because it's very similar to the client quote below that, is that despite the obviousness to some extent, and despite how long we've been dealing with cyber as a threat, and as many times and as many years as boards have listed this as their primary concern, and really up until this past year in the World Economic Forum's Global Risk Report that we were looking at the beginning, cyber is one of the very top risks, that our clients are really struggling to think about the impacts, as this one client articulated, to beyond the obvious. And I think that in many sense, this is really driven by two elements. The first is that we tend to define cyber attacks in the sense of, or cyber risk in the sense of, what's the data that I'm holding and what is the cost of a data breach? Or two, we tend to define it in terms of we tend to focus on first party business interruption, which is not to suggest that either of those categories aren't absolutely critical, and in many cases are exactly the point at which we should begin the examination of this type of risk when we're thinking about cyber. But the challenge is we've been working with our clients over the last several years on this, at least what we've been seeing and observing, is there's this imperative, very similar, Mike, back to your earlier comments about this need to develop frameworks to be able to evaluate this risk and bring the quantification in play. And the framework in cyber is no different. It's not dissimilar from any others that we're going to be talking about today. And that's really that we have to examine that the risk across the client's value chain. In other words, where is it that the technology platforms are playing? How is it that organization, from this concept of production and operations, how is it distributing those goods, if you will, or services to its customers? But also, what is the impact on those customers? And this very much this idea of extending our sense of cyber risk, not only just beyond the enterprise, but beyond necessarily the insurable or the transferable risk, brings us right back into that broad matrix that Mike was talking about a few minutes ago. And your comment, Mike, about this idea that emerging risks, right, that at least our working definition are those which have perhaps some degree of transferability, but also include elements of risks that are non-transferable. And if we don't expand our aperture, if we really narrow our vantage point, if you will, to the sense of data breaches alone, for instance, to evaluate the cyber risk, then it's very hard to be thinking about this expanse across the data chain. And when we think about this, back to this concept of velocity of risk, from that perspective, and we examine what we think about what that means. We've just included a few statistics here on the upper right-hand corner of the slide just to kind of ground us in this. And it's not that I think any of us need a sense or a reminder, given the polling responses, of how bad this risk can be. But what it's really suggesting to us is that we start to think about risk from the need to redefine cyber risk, if you will, from one as a technology risk to one that is seen through the lens of a business risk that's owned by the different business unit owners within an organization. It's not just the purview of the chief technology officer or the chief information officer. And so as we think about this, right, one of the questions being posed is, should this not be part of the property supply chain or other liability programs? And that's exactly sort of that comment of the matrix we were talking about before, which is that these emerging risks, will always impact us back in one of our traditional asset categories. But this idea that we need markets that can specially and increasingly provide technical underwriting to this type of risk are critical to this end. Mike, comments on this?
I mean, the main thing that I would add is that cyber is a great example of kind of the potential for overlap in across emerging risks. If you think about cyber risk and the geopolitical risk in particular, there have been some very high profile events such as the Sony breach that happened a couple of years ago that were directly linked back to state actors in that case in North Korea. And as we think about the future of geopolitical risk, a lot of what we are concerned about is conflicts among geopolitical rivals manifesting themselves as cyber events.
Yeah, and as we see this, right, that I think that the top concerns on our clients' minds right now, and we're much related to the COVID discussion we were having just a moment ago, is related to foreign intelligence or nation state activity seeking the theft of the intellectual property of the COVID vaccines and the development. So again, this idea that as we look at this, in our approach to this, we would argue that it's much like as the imperatives we were talking earlier about the imperatives of pricing emerging risk, is to provide quantification models and to take a quantitative lens to this, to be able to view the risk across the value chain, to view this in financial terms and financial metrics, KPIs, if you will, that we'll be talking about, but through the lens of this idea of how do we minimize the cost of the risk, at the same time, reducing the greatest amount of volatility across our balance chain. Because again, this is not a threat that's going to be going away anytime soon. Next slide, please. So just shifting our attention one more to the other top risks that you identified in your poll this evening as we were looking at this in the beginning of our discussion was climate risk impact. This certainly, as we start to understand that, and again, regardless of vantage point, the frequency and the severity of climate events is certainly increasing. The impacts on our clients, on the insureds, is certainly magnifying from that perspective. And as we start to go forward from that perspective, the question then becomes is how do we bring climate risk into focus when the insurance markets price this risk one year at a time? All right. I mean, fundamentally, as we move through the property renewals with our clients, that is what is happening from that perspective. But actually induces, and certainly I don't need to tell you all this, but induces no shortage of or a small amount of stress on the insured from the perspective of evaluating then the impact, one, not only in the operations, but two, just from a pricing perspective of how to budget for this type of impact in your property programs. And so as we think about this from a climate perspective, and again, it's back to this thematic that Mike articulated in the beginning was, how do we widen our aperture to not just look at a discrete impact from any one of these risks, but also to be looking at this, from not just a property perspective, but start to bring together this integrated approach from this perspective of physical risks, the supply chain, and the business continuity. To this end, I think there's three things that we need to be contemplating. One is the application of natural catastrophe or CAT models. And instead of applying these in sort of the traditional one-year focus, but to be challenging ourselves with these models and to be overlaying those models with other data like satellite data that can show us and give us a sense of real change over time of what's happening in different geographic areas, but challenging those models to provide multi-year forecasts so that we can then start to build simulations around these events. Secondly, I think as we're going through this, and the question is, how do we apply those simulations to the insured's property pricing? Just even from that central discussion of how much insurance should I buy and how much will that risk transfer, that risk financing cost me in the next year? But the ability to help clients think through what those alternatives might be as the markets continue to be challenged from both a capacity and a pricing perspective within that sense. And then thirdly, I think it's incumbent on us as we're bringing this into bear, and especially as you think about South Asia from that perspective, or broader Asian impacts, is how do we then start to think about the impacts of physical climate risk across the organizations, their ability to operate, again, as the severity and the frequencies of these storms build. And it's about taking those three questions, bringing them into focus through these decision frameworks and these different models so that we can make decisions not only about the appropriate transfer of risk, but the price to pay for that and how to understand that in the broader sense. Lastly, Mike, before I just flip this over to you for any comments you might have with respect to climate, the other aspect of this that is increasingly of importance to our clients is the question around ESG and how that framework that's coming into play in Europe, certainly in the United States in the next several years, both from a banking and investment perspective, but also corporate development or corporate disclosure perspective, is going to be impacting companies both globally, but also companies with extended both technological supply chains, like many of those value partnerships of the technology sector sitting in India, but also from a manufacturing perspective, regardless of where those assets sit. So again, climate risk, not only the second risk, as you all indicated in your polling at the top of the discussion, but increasingly of concern for our insureds globally. Mike?
Yeah, no, I mean, I guess the only thing I would add is we've obviously been through the end of a kind of cyclical low in property pricing, and then seeing a sort of a cyclical hardening, and then the question really out there on this question is how much to what degree does that become more of a secular hardening if climate events prove to be sustainably more frequent than they have been in the past. And and this is it's a long-term risk in at least a couple of dimensions. One is, as I mentioned before, this idea that climate risks tend to manifest themselves over a long period of time, as opposed to being particularly sudden. And the other is that our clients are making decisions every day about where they want to be located, but those are long-term decisions. You can if you decide you wanted to trade out of a location, there are significant sort of switching costs in that kind of a decision, and so they tend to be the kinds of decisions that we try to enter into in a very thoughtful way, because we're sort of stuck with them for a long time.
Fantastic. Next slide, please.
Good. So next slide gets to the geopolitical risks, and the exhibit on the left-hand side of this page is another one from the recent global risk report that we work on with the World Economic Forum each year, and it basically shows that geopolitical risks are moving up in salience with actors in the market over time. That's really not surprising, and I expect that next year they will continue to rise in salience. Certainly, the COVID crisis has highlighted China as a source of risk in the geopolitical sphere. I don't think that's a new trend so much as an amplification of trends that have been building over the past 10 to 20 years as China has become a much more significant actor on the world stage. China is obviously, it's a rising power with geopolitical ambitions to challenge this unipolar hegemony that the US has enjoyed since really the end of the Cold War. And even, long before the crisis, the current pandemic crisis, tensions have been rising markedly on trade and spheres of influence well in advance of this year. I certainly don't have to belabor that point for an Indian audience who is really has a front row seat to China and their ambitions. To date, the U.S. continues to enjoy military and financial preeminence, particularly with respect to the U.S. dollar remaining the global reserve currency. But China, over the last 20 or 30 years, has come to just about equal the United States in gross domestic product, at least as measured on a purchasing power parity metric, and then also is an essentially equal player in terms of share of world trade, and is rapidly closing the gap on technological innovation. So this sort of 30-year honeymoon from great power politics that we've enjoyed globally is going to be coming to a close if it hasn't already. And that's something that we think is probably going to be one of the biggest sources of systemic risk in the world over the course of the next 10 to 25 years. So Reid, I don't know if you want to talk a little bit about the Middle East.
Yeah, very similar, fairly similar dynamic, as we think about it, but in another area that can create reverberating and cascading effects across the, if not fully systemic, Mike, is the rising instability in the Middle East. And it's almost as if we could put rising instability in quotation marks, given what we've witnessed through multiple conflicts over the last 20 years since 9/11. But recent events really starting to heighten that concern, where it's cited on the slide, right, that we're watching a multi-confessional state like Lebanon, not only with the devastation that occurred with the tragic accident and explosion at the port recently, and the devastation through many parts of the city, but also a nation state that is struggling both politically and economically, let alone the fact as we start to think about the impacts of the lessening reliance on carbon economies, especially coming out of the Middle East. What a few years ago, the U.S. replaced, the Middle East as the net exporter leader amongst those petrochemical products. And we started to view that really causing some shifting dynamics and challenges where we just hadn't seen them to date, even in nation states like Saudi Arabia, which is having ripple effects into Jordan and beyond as capital is becoming more scarce, and they're thinking about transitions of their own economies. But I think the point of this is true as we get to this point, whether or not we're thinking about this from different parts of the globe, but this idea of this, Mike, as you put it, right, this honeymoon from great power competition. What does this mean for insurers as we've been witnessing as an uptick in political risk insurance trends, renewed interest, or again, upticks in people purchasing from trade credit, both from the buyer-seller side to protect their accounts receivable, their supply chains, and to provide that types of insight. So again, as we look towards these issues, the question I think for insurance buyers is how can we use insurance markets to start to hedge these risks, because we're thinking about strategic risk, and in these cases I would even argue external risk, into a sense of how can we apply those and manage those from the balance sheet through different insurance solutions from that side. Next slide. And Mike, back to you.
Sure. I'm conscious of the time, so I won't belabor this point, but coming back to kind of the general framework from some of the deep dives that we've just been doing on particular types of risk, we think that it's by employing this sort of framework and sort of quantifying risk, we think that provides an opportunity to connect our risk management strategy to resilience and the broader sort of risk and resilience strategy back to general corporate strategy. Again, we think of quantification as being, particularly sort of relevant and useful in this regard. We're big believers in employing sort of financial stress tests, thinking through scenarios and how they play out in our income statements and balance sheets, thinking about sort of both expected costs and, if you will, a kind of the mode year or a typical year versus the volatility that can be associated with these risks and the outlier years where there's a significant event, and then thinking about engineering risk solutions and optimizing strategies to both sort of push down that kind of average cost in a particular year, as well as try to mitigate some of the volatility to which we're exposed, whether we do that with an insurance solution or through some other means to engineer the risk down. And we think that is an important sort of dimension to a company's overall strategy for how you think about your financial projections and your financing and capital planning over the medium term. So Reid, I don't know if you have anything you want to add to that, or maybe
no, I think that.
I think the next slide,
yeah,
maybe to that, how we would do that mechanically.
Yeah, perfect, Mike. So, the way that we tend to think about this is really from the mechanics, as Mike put it in this approach, is a process, again, centering around the value chain. How do we think about where these risks are going to impact? These shocks can impact and manifest themselves across an insured's value chain. And then being able to both use that discovery process and again, as Mike said, tying this to the corporate strategy from that perspective. We recently did a small poll of some of our North American clients. And interestingly enough, almost 75% of them, of this select group, indicated that their insurance buying wasn't strategically tied or wasn't tied to the overall strategy of the organization, right? That it was very proximate in nature of, I'm buying each year and I'm renewing each year. And so the question as this era of lower limits, and lots of coverage grants is starting to invert, right? As pricing and markets are hardening, the question becomes in that second phase of through that value chain analysis of how do I understand those impact drivers around my first and my third party costs? How am I thinking about regulatory exposures, right? Is the world's regulatory environment one emerging risk that we haven't really talked about today, but in that middle column becomes so imperative and is a result of many of these risks. And then how do I understand those across the rest of my organization? We then want to think about those, as Mike alluded to, by generating different scenarios of impacts at the firm level. How do we even think about those at a subsidiary level of the organization? In other words, what is happening not just at the enterprise level, but below that, and then equally to that at the global or the industry level, sector level, to be able to bring this together through simulation approach and modeling. As one of the questions that was posed earlier, right, is how do we think about designing and rating risks specifically with cyber? But it's this type of approach where we think that can add a lot of value to that type of question, because that then allows us to then bring that back and examine that cost versus volatility of the risk. How am I understanding what that risk, what I'm paying for that transfer of the risk versus the volatility that is remaining in my balance sheet? And equally important as we start to optimize insurance spend, especially as market conditions are hardening from that perspective, that we're also incorporating and pulling into this the other areas of risk capital investment that organizations like yours are spending, right? The control environments in your cybersecurity that you're spending on, your enterprise risk programs that you have designed, and the business continuity programs that you've pulled into place, that are capital investments to that end, so that as we bring both the insurance and the broader risk pictures together, we're not just optimizing around the efficiency of risk of insurance, but we're optimizing capital around this total spend of risk capital in itself. And then we can start to think about how that de-risking of the environment happens over time. We do find, though, that increasingly it's become important that we're then translating this and not only just communicating these types of results to all of our stakeholders, which is just to state the obvious, but to do so in ways that our CFOs, that our boards, that our general counsels are thinking about risk from the perspective of translating this into financial KPIs and pulling it out of the insurance language to then be thinking about exposures in terms of CapEx or OpEx or revenue impacts and beyond to assist with that capital planning decisions that Mike was talking about a moment ago. Mike, any comments or thoughts before we go to the next slide?
I think we can move to the next slide. I mean, what we really wanted to sort of leave you with is a few takeaways from the main ideas that we've tried to develop today. The first of these is that the risk landscape really, we believe is expanding and expanding at a faster rate than it has in the past, and that these new risks can manifest themselves with really tremendous velocity. The second point is that we really think it's important to think beyond insurance, as many of the most important risks may have either incomplete or non-existent insurance solutions. The third is that sort of unifying your risk framework to take into account both insurable and uninsurable risks and try to put sort of apples to apples sort of quantitative metrics around those different risks is really a useful and increasingly we believe will become a critical tool for risk management. And then just finally, what the ultimate goal here is to try to integrate risk resiliency as a key sort of strategic tenet into the core of your company's overall strategy for financial management and positioning the organization for success in the future. So Sanjay, I think you're trying to talk, but you're on mute.
Thank you.
Okay.
Thank you, Reid. We'll invite Paul during the question answers. I'm sure he will have some very valuable inputs from the Asian market experience. We have a number of questions. One is, we invite Mr. Jolly from Sun Pharmaceutical to raise a quick question. So can we put his line open and get him to share his thoughts? In the meantime, may I leave a request to all the participants? You can type in your question in the Q&A tab down below, or if you raise your hand, we'll try and unmute your line and get you live. So we go over to Mr. Jolly. Have you unmuted his line? Mr. Jolly, please. Your line is unmuted. Please unmute yourself on your screen and you can speak your question.
Yes, Sanjay. Am I audible?
Yes, sir. We all can hear you.
Sure. So thank you, Sanjay, and I'm in full agreement to the takeaways, and detailed insight of given by Reid and Mike, because risk is ever evolving, and we as a risk manager, facing opportunities and threat at a pace which is very much different from that of the past, And black swan theory proves this fact every time, we come up with a big risk like COVID-19, So I always say that no problem in this world can be solved with the same kind of unconsciousness that created it, We always have to be ahead of the curve. We always have to be ahead of the crowd, And as such, our diameter of the potential problem have to be bigger enough to absorb the diameter of the problems, diameter of the solution has to be bigger than the diameter of the problems, and the astrophysics defines the term the dark energy, which says is that universe is on a perpetual expansion, and so does these risks, these problems are. So one of the key lessons from that ongoing pandemic is that risk manager has to look at the extended worst case scenario while identifying risk, because we cannot keep our horizons restricted to the perceived risk. So from this perspective, I feel that cyber risk has to be it is being evolving very fast, and the exposures are not restricted to the conventional technologies or the data risk. And we have faced in the recent past kind of exposures, whether it is related with the physical damages or the bodily injuries, or a lot of lawsuits in the DNO segments. So typically these risks are either fully excluded, or it's not explicitly mentioned in these kind of traditional policies. So my questions to Reid and Mike is that so what are the solutions available to mitigate, manage, or transfer this kind of an risk? Probably one of the things could be kind of wherein we can have this kind of solutions through that cyber gap or so. But I don't think whether that's even the cyber gap is kind of an good enough to handle all this kind of an uncertainties also in the cloud. So
thank you, Gurpreet ji. Really appreciate. Reid or Mike, anybody would like to take question on how to handle the cyber risk for a risk manager? Thank you, Gurpreet ji.
Thank you, sir.
You want to start with that one, Reid?
Yeah, sure, and certainly, Paul, please weigh in on this. I think that there's a couple of things that to be thinking about, and I very much appreciated your discussion about perpetual expansion. I think the other thing that we've learned from physics with respect to risk is the sense of entropy as we start to move forward in this respect, sir. It is, we think about that cyber gap, and as we start to talk about all the new applications that are coming in, right? Our clients are dealing with increasingly moving to cloud solutions. Many of our clients are existing with hybrid cloud, on-prem fabric type solutions as they're dealing with. First of all, as I think that too many of our clients are struggling to understand even what the quantum of risk is from that cyber perspective, because again, they're too narrowly defining it in terms of sort of very traditional first-party data breach areas. Secondly, I think, sir, that as this is going forward, that those gaps that you're alluding to are only going to grow, not only necessarily perhaps in the coverage aspects, but as we start to think about the technical E&O risks, as more and more of our clients are using and deploying artificial intelligence or machine learning solutions. And in many cases, rather than building their own, they're renting them, if you will, right, from third parties and deploying them. So the question becomes at the end of the day is who owns the liability from the deployment of those systems, or similar to robotics process automations that many of our clients are dealing with going forward. So I think this really suggests that we've got to be able to measure the risks differently, to your point, to understand then where our traditional coverages can apply, understand where those gaps, as you alluded to it, occur. We're increasingly seeing three concerning areas for our insureds amongst these coverage areas. One is a gap between cyber policies and crime policies due to social engineering attacks. The second, for financial institutions, relates to the banker's professional liability or the financial institution bonds, right? Is again, these risks cut across these or very traditional E&O coverages. So very, very important, not only to get your arms around the quantum of that risk and how it's evolving, but two, to be doing increasingly frequent gap assessments across the policy areas. And then third is looking towards new insurance market solutions, some of the parametric solutions that are starting to come out around cyber. Paul or Mike, any comments from you on this?
I mean, the only thing I would add is that the one thing that's certain is that we're not going to be able to cover the full waterfront with insurance solutions. So as our clients think through these issues, we're spending an increasing amount of time with them thinking about what are the assets that you're trying to protect, what are the defenses that you have in place, how can we try to help optimize that portfolio of defenses. And then as you start to think through scenarios of exposure, how does that sort of get fully kind of costed into the business case for any particular strategy? And so those are those are issues that I think will be evergreen as as our understanding of cyber develops over the course of the next couple of years.
Thanks, Mike. Paul, you have any comment on this, or?
Well, just Mr. Jolly, just from an Asia perspective, I mean, I could say, 3 years ago, really no Asian companies were really buying cyber insurance. Probably a couple of years ago, they would sort of think they could rely on their other policies, their property policies, their liability policies. But yeah, as we know, the insurance companies have really extracted all cyber cover from those policies. So one by one, we're finding our clients across Asia are buying cyber insurance. And I put them into two categories. One are companies, they just think, okay, I need some cyber insurance. I'll just buy something with a small limit, so I have something, and they have a policy. Others, bigger companies, maybe like yourself, are really going first into, with us to assess what is the exposure that I really have before they get to the insurance piece. But for sure, one by one, every company is looking at buying cyber insurance now in Asia.
So we had Rakesh Jain, the Chief Executive Officer of Reliance General Insurance Company, raising his hand. So Rakesh, we have raised you to the panel. Would you like to ask a question or share a comment? Rakesh, thanks for joining us.
Thank you, Sanjay. Thank you, Mike, Reid. I think it was a very pertinent topic to be picked up at this stage, and all of us being very aware of risk, or maybe it's heightened in our mind. But I just wanted to ask as a simple and a question, that if you analyze risk from various ways, various dimensions, and we see the financial consequence on an organization at large, what kind of risk reserving practices would you recommend more for the unknown things which are likely to hit you? The known ones, I would presume, over a period of time, you'll be able to transfer. But when you see the pandemics like the global ones, or maybe the financial meltdown or geopolitical risks rising, is there any recommended advisory for strengthening the balance sheets for organizations from your perspective? Thank you.
We can keep all the money in the balance sheet and still not save ourselves. Just on a lighter note.
Fair enough.
But Mike, Reid,
Yeah,
it's
no,
a great
I mean,
question.
look, it's an excellent question. I mean, it comes down to a very difficult sort of conundrum, which is how do we reserve for kind of unknown unknowns, right? And that, I think what it does militate towards a certain conservatism of finance, right? So if your financial resources are spoken for from the risks that you can anticipate, then you probably don't have adequate cushion, because there's almost certainly something lurking out there that hasn't been anticipated, or maybe has been underestimated in terms of its focus. Obviously, we've worked with clients to kind of help think through different scenarios and try to put numbers on things that maybe hadn't been sort of well quantified in the past, and at least start to give a ranging shot for what sort of sort of available resources you might want to keep in place. And then there are other strategies around, for instance, using a captive to explicitly budget for risks where there might not be a sort of either available or reasonably priced solution in the market for laying it off, or potentially as a vehicle for accessing reinsurance markets to get at different pools of capital that might not be available if you didn't have your own captive company. So there are definitely strategies that you could think about. You'll never completely be able to deal with the fact of the kind of the inherent unanticipability of certain events that will befall you. But what you can do is get a sense for how your available financial resources stack up against the risks that you are aware of and that you can quantify with some degree of certainty, and then see if there is any margin for error once you've gone through that exercise.
Thank you. We are now asking Shankar, the chief for Indian Lloyd's operations in India. Shankar, we promoted you to the panel, and would you like to share a comment or a question? You had a question around how reliable are the models, yeah? Shankar, would you like to unmute your line and ask a question?
Sorry, Sanjay, can you hear me?
Yes, Shankar, we can hear you.
Sorry, I just lost all of you for a second. So yeah, the question that I had was basically, how reliable are these stochastic models, given that the pandemic is kind of evolving? Nobody really knows how it is actually evolving or even mutating into whatever. And also it varies from country to country, right? So it's almost like, how do you price a risk? Whether it's business interruption, whether it's health, whether it's whatever. So how reliable are these models in your view, please? Thank you.
Do you want to start with that one, Reid?
Sure. Look, it's a fantastic question because with the mantra, right, of all models are wrong and some are useful, I think has to come with all of these types of discussions. But I would tell you that, as we think about from the pandemic perspective itself, that when you're modeling and you're creating forecasts within and this speaks to, I think, the heart of your question, right? The models can be incredibly accurate within about 4 weeks of a time horizon, which is far too short to be planning for business interruption or capital allocations or investments, as the second part of your question suggested. The further you go out from that 4-week time horizon, the more difficult that it gets to have fidelity. But within there, again, depending on the quality of the data that we're receiving as the inputs, we're finding that our projections are inside of 2% of the actual values, right? When we look back at what has actually happened and unfolded. To deal with that uncertainty, to parameterize that future uncertainty, this is where I think that Mike, what you were talking about earlier, maybe you could expound on it, is using scenarios to start to stress test these outcomes. If we don't know what the parameters may be 4 or 5 months out, one of the techniques that we use, and in fact for that global professional services firm with that large presence in India, was if we can't tell them what's going to happen 5, 6 months out, was to build out what those thresholds were, so that if we saw, for instance, the infection rate or the positivity rate increasing at a certain glide slope, that it would give them enough early warning that it would tell them that they were likely to move into a high, medium, or low band of impact on their own workforce from that perspective. So either looking forward and using kind of a backcasting technique, or secondly, using scenarios to test that is one way to start to parameterize those types of uncertainties. Certainly, as we move out to the other types of emerging risks we've been discussing, right, different techniques are being applied to the stochastic simulations for cyber or the climate models that we're talking about, but no less different in terms of the challenges to your question, Mike.
Right. Yeah. No, I would say that it's useful to kind of think about things in different sort of chunks of or different horizons, right? So to the point Reid was just making, certain models the models have developed to a point where they're actually pretty accurate within sort of what we think is going to happen over the course of the next month, and that there's utility in having a view and from a crisis management perspective. That's obviously important, and you can make relatively sort of precise statements about that kind of a time frame. And then there's sort of like a 6-month view, right? And then I think you have to start to think about how you have to think more in terms of scenarios and less in terms of models, and saying, well, what might happen? What is the rate? Can we put bookends on a range and then say, well, what will be the most important ways that we can prepare for worst case scenarios, or to keep scenarios from developing into worst case outcomes if X, Y, or Z scenario becomes the most likely. And then I think there's the sort of the longer term, which is to go with respect to, say, pandemic risk beyond this pandemic. What have we learned, and then what does that mean for the footing that we should be on? And again, that can apply to companies, that can apply to governments. For instance, I think that what you will see is a less of a reliance on global supply chains for critical items such as protective gear or pharmaceuticals. I mean, this is highlighted in the United States. The reliance that the U.S. has on India as a choke point in the supply chain for pharmaceuticals, manufacturing, and China for the materials that go into the manufacture of drugs that are critical here in the United States. And I think that you will start to see policymakers make changes in terms of supply chains. I also think that you'll see companies make fundamentally different decisions, balancing, if you will, kind of efficiency with resiliency in different ways, and building more redundancy into supply chains. And I also think that we'll see. We've learned a lot about the efficacy of lockdowns and the right sort of period of time for a lockdown to stay in place. And I think that will affect the next event in terms of what, I think we will see in the next event, for instance, shorter lockdowns, unless you have a fundamentally different kind of manifestation of a pathogen that has maybe, like a different kind of mortality profile. I think you would see, just a different approach as people look at what the lessons that we're learning from this experience. So I think breaking into at least those three kind of time horizons of the next 3 to 6 or 8 weeks to kind of the next sort of 6 months to or maybe a year, and then playing that out to how how the world might react to a similar event in the future that's unrelated to this particular pandemic.
So I'm combining a couple of questions which I see. There's a question from Jimmy Gopalakrishnan and also Mr. C.V. Srinivasan. Their question was around, are there any specific examples we can share on other risk transfer solutions beyond insurance, which will help people appreciate? So if insurance world is not ready to take the risk, organization world doesn't want to take the risk, we all want to transfer the risk out, what do we do?
We have worked with clients on alternative risk transfer schemes. Some of those are, have insurance capital behind them, but don't have typical sort of indemnity types of coverages, but are more parametric in the way that the payments are triggered. Those tend to be more bespoke transactions. They tend to be a higher cost in terms of rate online. But if you have a particular vulnerability that you find to be unacceptable, then that has been options that we've been able to sort of put together for clients. So indemnity insurance is one way of hedging risks. It's probably the largest sort of pool of capital that's available, but it's not the only solution.
Paul, you see some examples happening in Asia, clients going for ART solutions? Is it something becoming more in demand?
I mean, yeah, and I was going to mention to the audience, where like in this risk series, I think maybe it's the next one, or there is a Marsh session on ART and parametric risks. So an alternative way of looking at the insurance. So hopefully anybody that's actually interested in that can join that session, and we'll have a specific discussion around that. But yes, we are seeing more interest in around that. You know, as in India, some of you have had some sort of fairly shocking rate increases because of the particular situation there you have with GIC. But this is actually true across the whole of Asia. Many companies are seeing significant increases in the cost of their insurance. So this is driving them to a couple of things. You know, one, they're questioning, why am I buying this insurance? Am I buying too much insurance? And so we're starting to use some models to do some modeling to help them make assessments, whether the insurance they're buying is creating value for them, whether the insurance they're buying is and that then naturally discussions around insurance companies. We've seen an upsurge in Asia in the last 6 months of many companies looking for the option of creating their own captive insurance companies. So yeah, a lot of this discussion going on as the risk profiles change and as insurance becomes more expensive.
I mean, in terms of deploying one's own capital, that's definitely a macro trend, especially for our largest clients, as their balance sheets become more capable of absorbing risk. And this has been a bumper year for Marsh. Has the biggest captive management business in the world. We manage about 50% of global premium in captives. We place almost as much premium in our clients' captives as we do in the external markets, actually. And we have formed 3.5 times as many captives in 2020 year to date as we did in 2019. So it's clearly the case that the hardening market and increasing sophistication on the part of our clients with respect to risk finance is causing them to take a hard look at captives as an option.
So this is one of the last questions, I think, given the time. There's a question from Mr. B. N. Narasimhan around India is now a major IT hub, serving the global companies across the globe, providing IT and IT solutions. Any message for that industry in terms of, given the risk events, what we are saying, what as an industry class they should be looking at, or how their customers are looking at India providing IT services as a risk? Either way. Anything you want to share, which could be a message for the IT clients? Many of them are present here.
Sanjay, I think that
please,
I think this topic, I think for many Indian companies, maybe not only in the IT segment, I mean, as well as the defensive element of it, or the risk element of it, you can think about this as an opportunity as well, because as Mike's talked about, many foreign companies are looking very, very much closer at their supply chain. Potentially globally, some decisions will be made by governments, so they'll want to bring the production of some critical items closer to home, or in fact, back to home. But outside of that, there are many, many things where India is a critical part of the supply chain for many global companies. So to that extent, within India, with your competitive group, you can probably create more of a competitive advantage for yourself by being able to demonstrate that you have strong resilience within your organization. You're looking at the many aspects of risk, and when these various traditional or non-traditional events come along, that you're going to be better placed than anybody else to continue that supply. Reid gave the example of the work that he did for the global consulting company, and they were very much looking at, we've got all these global employees, we've got thousands of employees in India, but we're completely dependent on them to produce for us so we can produce for our clients. Can we really rely on that? So I think to the more that the Indian companies can demonstrate that they can be relied on because they've looked at all these traditional and emerging risks, then the better competitive advantage they'll compete within India, with your competitors in India, but also within Asia. Obviously, many companies are looking at, how do they exit from China for political or supply issues. And then, maybe this is an opportunity as well as a sort of risk issue for India.
Great messaging, a greater confidence on customer if India as a supplier of services is able to demonstrate greater control on managing its own emerging risks. So good. Any parting comments, Mike and Reid, as a takeaway for everybody? There are some more questions coming up, but I'm conscious of the time. We have dropouts as well. But key takeaways, anything which you think you would like to again summarize or mention to all the people, both Reid, Mike, and Paul.
Mike, do you want to go first?
Sure. I mean, I guess the key takeaways, I think, is draw a big box around how you think about risk management, and the biggest risk that is facing our clients is a failure of imagination, and so keeping an open mind about as to what might happen, and really driving to the next level in terms of trying to put some numbers around that, as opposed to just sort of focusing on what we did last year. I think is going to be critical as the pace of change in the world continues to increase. It's up to us and who are risk professionals to be looking around those corners.
Reid, Paul, yeah.
I think the only thing that perhaps from my perspective is that we have seen, as the COVID crisis has gone on, an increasing number of our clients are asking questions about, and Paul, this goes very much to your point about this is an opportunity, right? How can a company in India differentiate around risk? By showing that they've got that resiliency and that they are seeing around the corners that Mike has talked about. And so the vendor risk management efforts, or the discussions that we've been having at senior levels with our insureds, our clients have moved in the last 8 weeks, Sanjay, have moved from how do we contractually ensure that we're managing our vendor risk or our supply chain risk or our joint venture risk, or subsidiary risk offshore, to now how do we view that through a lens of resiliency? And is that resiliency, right? People didn't think about middle office or BPO functions being at risk from a government shutdown when the Prime Minister in India, right, imposed the shutdowns and said everybody has to go home, and when the employees were all sitting with thin client architecture and couldn't take their computers home. Corporations around the world were impacted, right? So how do we demonstrate that type of resiliency and start to show that, I think, is a true opportunity to really differentiate around the risk as you're going forward. That means insurance, that means demonstration of alternative risk alternative risk transfer. That means the integration of those insurance programs with your enterprise risk management and your business continuity programs to provide that integrative view to those that you're doing business with. And I think that is going to be the next area of differentiation beyond product, speed, and value, is going to be firms that can differentiate around risk.
So resiliency as a differentiator, great value. Paul, any quick final comment?
Yeah, so I think most of you on the call are responsible for insurance buying or for risk management, and you have a very complicated job these days. Probably 10 years ago, you probably only needed to worry about fire and flooding and theft, but today you still have to worry about those things, and it's more expensive to buy them. But in addition to that, you need to worry about cyber, climate, operational risks, ESG. It's a very complicated world out there. But what we say is, whilst you're looking at those things and you're looking at them from the risk aspect, look at them from how you can use those things to create competitive advantage for your companies.
So thank you, Paul. Thank you, Reid, and thank you, Mike, and thanks all the participants. It's been a great learning experience for me, and once again, thank you all.
Thank you for having us.
Thank you. Bye-bye.